All right, I think we'll kick it off in a few. Well, actually, why don't we just start now? All right, everyone, thank you for joining us here tonight. It's going to be an interesting panel as we have a lot of esteemed guests joining us for today. Now, with the uptrend of tokenization, it's on everyone's mind what the regulatory landscape will actually look like. And as you join us here tonight, we're actually going to explore the legal intricacies and regulatory landscape surrounding real-world assets. So in this session, we will delve into the complexities of obtaining licenses, the types of assets requiring specific regulations, and of course, the challenges that affect the landscape, that is tokenization of RWAs. Before we begin, I'd like to greet our guests for tonight, and we'll start it off with InvestaX Co-Founder and General Counsel, Alice Chen.
Okay, I guess ladies first. Can you hear me okay?
Yes.
All right. Yeah, as Jean mentioned, I am the co-founder and general counsel for InvestaX. General counsel is just a fancy name for a lawyer. So many of you would probably know that InvestaX is a Singapore-based and licensed tokenization and trading platform that focuses on security tokens and tokenization of real-world assets. We offer the end-to-end solutions for basically any Web 2 investment firm to become Web 3 compatible with the infrastructure that we've built. I think in our space, we're considered an OG. We started in 2017, looking at bringing in blockchain technology, trying to introduce it in a legal and compliant way to real-world assets. Like real estate, art, whiskey, luxury goods, and also trying to introduce the concept of tokenization to TradFi, and primarily focusing in the private markets. And we'll probably get into this a little bit later on why that is. But as a platform, we've managed to put out a number of world-first projects like Project EVCC, tokenizing our own company ESOPs, tokenizing an NFT, the BAYC, and fractionalizing it into a security token offering. And I'd assume some of our listeners would be holding these IXAPE tokens. And so you're able to do a lot more with them. And we'll probably get into that a bit later. But that's a short and quick intro of what we do and who I am.
All right, thanks for that, Alice. Next, we have Head of Legal and Compliance for IXSwap, Derrick Leong.
Thanks, Jean. Hi, everyone. Pleasure to be here. As Jean mentioned, I'm Head of Legal and Compliance at IXSwap, and it is also another fancy word for lawyer. So IXSwap is basically a full-service RWA/STO tokenization platform. So we provide the full suite of services from start to end, which includes things like the tech, advisory, consulting. We have primary issuance solutions like a launch pad and another we're actually working on. We have a secondary exchange as well, which is based off a DEX model with liquidity pool. So we're actually proud to say we're the first in the world to have a DEX for security tokens. We are licensed in the Bahamas, and which crucially allows for retail investor participation. We've been up and running, I think, for a couple of years now, since we were established in 2021. We have our own utility token, which is called the IXS token as well, which is now on a few centralized and decentralized exchanges. Back to you, Gene.
All right, thanks, Derrick. And up next, we have Benedikt Schuppli, co-founder and CEO of Obligate.
Hi, welcome everybody. It's great to be here. My name is Benedikt. I'm CEO of Obligate. We started a company a few years ago. I'm also a lawyer by training, but I function as CEO at Obligate. But we started the company, together actually as a team of blockchain lawyers, and because we were convinced bringing traditional finance on chain, the secret sauce really doesn't lie necessarily in the tech or in the tokenization, but in having a reliable and scalable legal framework. And it's just been super exciting to see, how far we've come over the last 1 or 2 years, I think, as a space in general. While of course it's still just the beginning, but given the opportunity and the transformation potential is so vast, which is I think what keeps everybody going. Obligate is both an infrastructure and a marketplace. So it's an infrastructure and a marketplace where traditional corporates can issue digital securities with a focus on debt instruments. So we do commercial paper and bond, as well as structured investment products. And we've built a platform in a way that it's just uniquely efficient in originating debt as well as derivatives. And the issuers can do that in almost a peer-to-peer fashion with a few clicks. And however, we work with other players in the space, which is also why we're super happy that we are partnering with InvestaX, where we really believe we can build kind of a new layer of financial market infrastructure, where Obligate, being a Swiss platform, can connect with InvestaX, one of the leading APAC platforms, and we can originate assets that can be provided to InvestaX investors. And the beauty is, none of that really needs a full integration, but we can do that just using transferable digital assets, which is extremely exciting. Pleasure to be here with you.
Likewise, Benedikt, and thanks for that. Up next, we have JV Pineda, CEO of Bond.Ph, which is a subsidiary of PDAX.
Thanks, Gene. Hi, everyone. It's great to meet you guys. I'm happy to be here. I'm the CEO of Bonds.Ph. So it's a registered securities broker dealer in the Philippines. And I'm also the chief of staff of PDAX, its parent company. So we're a registered virtual currency exchange, as well as a registered electronic money issuer in the country. The projects I'm working on include, I'm currently working with the government on the tokenization of government securities, envisioning how it can be set up to add value on both the retail and the institutional front. Last November 2023, we had the POC with the Philippine government where we issued tokenized government bonds for them of about $270 million, of which Bonds.Ph and PDAX was a technical provider. On the PDAX front, we were able to make tokenized treasury bills available to the general public weekly at bite-sized denominations for as low as $10 from the previously high minimums of $200,000. And yeah, that's it. Thanks.
Thanks for that amazing introduction, JV, and great to hear amazing news coming from the Philippines. Up next, we have Jason Hall joining us from the morning. Last but not least, CEO of Methodic. Thanks, Jason.
Thanks, Gene. Thanks for having me. It is only a little bit early here, but happy to be here. I'm Jason Hall. I'm the CEO and co-founder of Methodic Capital Management. We are investment managers, private fund managers. We've recently launched a passively managed benchmarked total return Ether fund, or said another way, staked ETH, which allows investors to access ETH plus staking rewards using fiat, so they don't need wallet infrastructure or a crypto team. There's no need for changes to their balance sheet, no need for an in-house crypto team or custodial solution. And we are working currently to expand our business to include hybrid portfolios of tokenized real-world assets and crypto together. So I am not a lawyer, but regulation obviously touches everything that we do and how we do it and who we can do it for. So looking forward to discussing that.
All right, thanks for that, Jason. And you heard it here first, guys. It looks like we have an amazing setup of speakers for tonight. And before we begin, I think it's been clear on everyone's mind that tokenization of RWAs is the next trend or the upcoming trend for 2024. And with that comes all of the regulatory nuances and basically the clarifications that we need around that area. And that's what we're discussing here tonight. And I guess we're jumping into the first topic, which is understanding regulatory requirements, with the first question being, how do varying regulatory frameworks impact the classification and oversight of different types of real-world assets? I think we'll start with ladies first. So Alice, you can take it first.
Okay, sure. Yeah, no, I think first of all, it's a great representation of people doing real things in the RWA space, and a lot of brain power going behind each of these platforms, and we're actually trying to work with all of the RWA players, two of them here being represented. So I actually teach a course at Singapore Management University as a guest lecturer. And this started years ago. And the first slide that I have is to make a distinction between all of the different types of digital assets, because there was still a lot of confusion when we first started, and everyone just bucketed everything into one bucket. Okay, you're touching blockchain, you're doing tokenization, you must be crypto, right? But actually digital assets can comprise of so many different types of tokens, and each come with different regulatory parameters as well as tax implications. So you have utility tokens, which are not subject to securities rules. We all know that. You have security tokens or tokenized securities, where there was at one point we called these digital securities, any form of a securities securities offering that is in a token format, and these are subject to securities laws. And then NFTs came along, and then stable coins, which is meant to serve as a form of payment, but in many jurisdictions, and they've actually started putting out regulations specifically around stable coins in Singapore, for example. And so there might need to be a different category, right, for stable coins. Whereas in the past, I think everyone just put digital assets and equated crypto or utility tokens. But obviously, they're very, very different assets, subject to different regulations. And I think a good part of what we've seen post FTX has been that the crypto community and DeFi world has now come to accept a lot of the things that TradFi had been used to already, like KYC and onboarding, investor verification. And there's now being more introduction of requirements and regulations for dealing in digital assets, which is in line with what perhaps some of the traditional financial institutions have seen. Things like transparency, fairness in dealing, and certain reporting obligations, segregation of assets, things like that, which are, I think, all good for investor protection. But I think it's really just about having the right balance of legislation and regulation that's going to support innovation, at the same time protecting investors.
All right, thanks for that, Alice. Derrick, yeah, is there anything you want to add to what Alice said?
Yeah, I mean, I think crypto natives who are more used to seeing utility tokens out in the space would not be so familiar with what I'm about to say. But I think in terms of RWA tokens, more specifically nowadays, I think the other way to skin the cat or to answer this question differently from what Alice is saying is lots of the RWA tokens now have a specific structure or legal structure to them. And the types of regulations that would apply to these tokens would vary depending on the type of structure that's being deployed. And I classify these types of tokens under two main buckets. I think essentially you have situations where RWAs or real world assets are directly tokenized versus the other structure where they are indirectly tokenized. The difference between the two being direct tokenizing an asset basically involves converting and fractionalizing the ownership of the underlying the RWA into digital tokens without using any intermediary entities, right? So for example, tokenizing art into 10 parts, right? So the 10 different persons claim ownership in equal parts. Now, the thing about direct tokenization is it holds the promise of streamlined processes because you basically can leverage the blockchain in terms of the transparent and immutable ownership features that it has. But, there are many challenges with this. Things like, the limited use cases, practical difficulties, and regulatory hurdles as well, especially for RWAs, which require regulatory registration, things like that. I mean, I think indirect tokenization, essentially from what we've looked at in the market, is the prevailing structure because what happens is you set up like a vehicle, a fund pooling vehicle, you house the RWA under that vehicle and you tokenize it. And this kind of model is more attractive as an investment, I think, since the tokens, resulting tokens will basically be able to carry some rights to returns derived from the underlying RWA. And, it has the advantages also of having the asset ownership remaining under the control of the owner. Tokens become freely tradable and it unlocks liquidity and second trading as a whole. So I think different countries have different categorizations of digital assets, right? Principally, there are, I think, one class of countries which basically employ the existing securities laws and try to fit all the new types of digital assets under those laws, like the US. Then you have other countries which have come up with new laws, right, to address these types of new digital or virtual assets. I think in the indirect tokenization structure, these would be classified as securities under most laws. For direct tokenization, this would probably be some sort of digital or virtual assets or possibly even unregulated in other jurisdictions.
Thanks for that insight, Derrick. I guess, Benedikt, if there's anything you'd want to plug in here.
Yeah, I think it's what's really important is that we are, on the one hand, we do this because I think we here believe that regulation in and of itself can be a good thing. It can protect investors, can make sure that contracts are enforceable. Also, if there's counterparty risk, which cannot be reflected in a smart contract, so that all makes sense. And at the same time, still, trying to strike a balance and staying true to the principles of decentralization. And here is something where we just see, that a lot of the traditional players and incumbents, they also, talk about tokenization, and tokenization can, mean very, very different things. And so really trying to strike a balance of saying we want to leverage the technology, we want to lower transaction cost, we want to limit risk, and we want to disintermediate. We want to not use some of the old infrastructure providers, which are just not needed anymore with the technology, but at the same time try to do that not in a DeFi way, but with the comfort of actually enforceable legal instruments. And the more we do that on a global scale, obviously, the more challenging it becomes. And that's how I see it. And so that's why I want us to be bold. So if we come to 2023 and people say the best use case for tokenization is stable coins and to buy tokenized treasury bills, which have already been issued in a TradFi infrastructure. Some cases it's even an ETF, so you have a structure on top of a structure, which is then issued in the form of a token. I just don't think that's bold enough. So this is where I think, let's stay bold and true to our visions.
Yeah, if I may add to Benedikt's point, which I fully agree with, I think we're all here doing what we do because we believe in decentralization and removing intermediaries, unnecessary intermediaries. I always say regulation is probably there to curb bad actors. It's not there, because the technology is neutral. The technology itself is not bad, but there are definitely bad actors out there, right? Using the technology in bad ways, which is where the regulation steps in to curb bad acts. And from a public policy perspective, it provides users more recourse and comfort when they are entrusting other people with their investments, right? And it's not because we're all here because we believe in decentralization and doing it just in a more efficient and better way and removing unnecessary intermediaries. But yeah, it's that balancing act between regulation and protecting investors. That's why I think we've taken the route that we all have in getting the requisite licenses, and all of the segregation of duties and things like that could obviously lead to a massive failure if you don't have certain protections in place, as we've seen from FTX.
Yeah, thanks for touching part on that, Alice. I just also want to touch up on the fact that you mentioned decentralization, which is what Bonds.Ph and PDAX are making strides over there in the Philippine market. I guess, JV, is there anything you'd like to add onto these points?
Yeah, sure. I like the diversity of views that was previously presented. I think I can touch upon the viewpoint from an institutional investor standpoint, as well as from the perspective of the overseers. I'm thinking that if you're like a bank, then from a risk-weighted assets perspective, then I'm thinking that the treatment from a risk capital basis would be the equivalent traditional version of the tokenized asset based on a paper by the Basel Committee. But I just like to note that this only holds true if the crypto asset confers the same level of legal rights as ownership of these traditional forms of financing. So, for example, the rights to cash flows, the claims in insolvency. So I think that investors should definitely take note of this on ensuring that the RWA that they're investing in, if they have capital requirements, to fall under the strict definition for it to be eligible on the same level of treatment from a risk perspective. Then I think if we're talking about the oversight of real world assets, I'm thinking that this will expand the roles of the current regulators. So, for example, in terms of the primary issuance of government bonds, so this traditional activity is within the purview of the Treasury. Uh, and for the tokenization activities related to the primary issuance of the same of government securities, I think that such activities will still fall under their purview. I don't really see this changing with the introduction of tokenization, as we find the regulators are really collaborative, especially in the exploration of how this new technology can improve the way we do things.
Thanks for that take, JV. Last but not least, Jason.
Yeah, I probably don't have a ton more to add to what's been said already, because I agree with what everybody is saying here. I am in the U.S. We have, although we do most of our business offshore and our structuring offshore, but the United States has taken a decidedly different tact than most other regulators. And so when you're talking about regulatory frameworks and classification, you, in certain cases here, you have to start with who even is the regulatory body that you're dealing with. Is it the CFTC? Is it the SEC? And I think what we see in the private fund space, especially, is an attempt to utilize private funds and tokenized versions of private funds to reach investors. And in the US, unfortunately, that pushes you up the sort of investor chain, meaning away from retail and toward accredited and qualified investors. And this is unfortunately a very limiting thing. And it kind of speaks to the fact that, unlike what some of the other guests are talking about here, we just don't have the type of framework or clarity that's necessarily going to drive tokenization. So we're looking to other parts of the world, specifically Asia, but not only Asia, to sort of drive a lot of the adoption of real world assets, and sort of in a little bit of a regulatory holding pattern in the United States as we're waiting for clarity to come through. But fortunately, one of the huge benefits of tokenized real-world assets and tokenization in general is the ability for folks to partner and have boots on the ground in other jurisdictions and being able to participate that way. So we're quite appreciative of the work that's being done. One of the guests earlier talked about really pushing the envelope. I think that's right. And we're kind of in the U.S., at least on the U.S. side, a little bit along for the ride. So it's a bit of a different picture for us.
Yeah, thanks for putting that across. Yeah, I just want to touch on some points here. You guys mentioned a lot about decentralization, different types of investors. It's interesting to see that because it kind of goes in line with our next question being, what considerations should investors take into account when navigating these regulations? So I'll pass it forward back to you, Alice.
Well, sure. I was going to say, Derrick, I think you've done a piece on this, but I would say clearly, there's so many different types of real world assets that can be tokenized. Virtually anything can be tokenized, right? The biggest use case to date is stable coins, right? And as I mentioned earlier, there may be some specific regulations coming out related to stable coins in certain jurisdictions. But also just looking at the characteristics of what that asset looks like. Is it a debt offering? Is it debt securities or loan notes? Even within debt, there's different ways of categorizing these types of assets. And then you have equity investments, or what we do is economic interest tokens, where you get all of the rights to the investments, but you don't have to be involved in any of the governance. I know that there's a lot of debate on, for me personally as an investor, I look at my investment portfolio very differently. If I think it's a good investment, I want the upside, I want the right to distributions, but I could care less as long as there's a reliable manager in place and I trust that manager to invest on my behalf. I leave that job to that, trustworthy manager. So I don't care about governance tokens. I don't care about any of those rights attached to those tokens. And I'm happy to take, let's say, an economic interest token, right? And then there are other investors who do care, want to be involved in a lot of the decision making, and maybe they do want to have governance rights. And so those tokens are going to be structured very differently and have different rights attached to them. And I think, as Derrick probably will allude to, it will come with different obligations and reporting and disclosures, right? But that's just one consideration. But Derrick, I'll let you, chime in with any other thoughts.
Yeah, I mean, just to add to that, I mean, from the perspective of investor, I mean, which I believe most of us would be on this call, I think the three key things we would look at, token rights, obviously, looking at, the returns you'll be getting from, holding an investment or a token investment token, thinking about the protections in place, what happens if things go wrong, making sure that, safeguards are there to protect against, rugs or scams. If it's, for example, if it's a debt kind of offering, then making sure that, there's probably some sort of collateral or security that protects your principal, maybe even guarantees of some sort. And these are the sorts of things that we as a platform and IXFOB also look at, in our just sharing some of our experiences. When setting up deals on our platform, we do we conduct due diligence on the issuers, on sponsors, on assets as well, to make sure, that, these real assets actually exist, they are unencumbered, they are, well taken care of. For things like luxury goods, you have to come out with different considerations, like, making sure that they are authenticated and verified. So all of this, I suppose, is part and parcel of the whole process of tokenizing and packaging a deal up.
Yeah, and I think depending on the asset, you also want to verify that it's there, that it's being held in custody. We looked at a project, I think, on a platform, which was a collateralized debt offering. We had to actually secure a lien or file a lien against it in Malaysia. I'm talking about the Faxio deal, right? To ensure that the asset is properly secured. And so it really, really depends on the underlying real world asset. Some real world assets are probably not regulated, right? If you're purely fractionalizing a piece of artwork so that 100 investors can hold one piece of that one physical art, that is not considered a securities offering subject to securities regulations. But depending on how you structure it and the underlying investment thesis, are the investors investing with an expectation of profit? All of those considerations from the Howey test, and applying all the different securities rules, then yeah, different rules would then apply depending on the structure. So as Derrick mentioned, it requires an analysis of the underlying asset, how you're structuring it, which jurisdiction you're in, and what are the ultimate goals of the project.
Interesting. Is there anything you'd like to add to that, Benedikt?
So I think what's really interesting to observe is, the cyclicality of all of this, where I think in bull markets, we just see a lot of people interacting with blockchain-based investments that do not give them any type of legal claim. They don't know who the counterparty is. We've seen, now looking back 2 years ago, before the FTX fallout and 3 Hours Capital and everything, kind of in this CeFi lending hype, we've seen huge risk being taken, massive amounts of unsecured lending being done, not in, secured with, DeFi collateral, but actually unsecured. And that was because, the market was going well. And then as soon as we see declines and we see bear markets coming, then I think even some, DeFi maximalists will actually ask for some legal protection, and they want to bring things into court. And so that's something where I think it's really important, just, irrespective of the market cycle, I think it's really important that investors understand, what type of assets they're investing in. And here we already see nuances, in the stable coins, like, do I hold, digital assets in a cash-like form in USDT, which gives me much less rights than I hold them in USDC or in regulated electronic money. And these are nuances, but they can be extremely, decisive in the end for the investor protection. And I think here still a lot of education needs to be done in a space, especially as it relates to retail investors.
Great points there, Benedikt. Is there anything you'd want to probably add to that, JP?
I don't think I have much to add. But I think the investors need to take stock of everything. But as what Alice mentioned, the reputational component is especially important in this space. I think investors should also understand deeply their own investment limitations and parameters. That's it.
Any last final thoughts on the matter, Jason?
I think for investors, a lot of it's been talked about here, but we would advise people to look at certainly the legal claim that you have on the underlying asset. You also need to look at who has the ultimate source of truth for, the actual ownership? How does on-chain and off-chain administration work? Who is actually valuing the asset, and where does the value come from? Is that at the token level? Is it at the asset level? Is it, is the manager providing the NAV? What is the valuation policy? And then you start to get into kind of interesting jurisdictional issues, which it's unfortunate to think this way, but there's also a lot of lawyers on this call. But who do I sue when things go sideways, and in what jurisdiction? What is the recovery process? Fractionalization can increase access, it can increase liquidity, but it can complicate recovery if you're trying to liquidate that asset for any number of reasons. It doesn't even have to be fraudulent. It can just be business cycle related. We've talked a lot about credit here, and somebody was describing unsecured lending and kind of an explosion of risk there. I think credit is a very interesting space for tokenization because of the capital stack and sort of understanding where in the capital stack you are, which is hopefully clear, but sometimes in tokenization becomes a bit difficult of who else is in that product. Where is their claim relative to yours? You don't see as much of that being discussed when you're looking at decentralized and tokenized assets. And then another thing that we think about from an investor perspective is what sort of geographical diversity do you have in your portfolio? And what I mean is tokenization can allow for tremendous access to real world assets, all around the world. Real estate's a good example in being able to, invest in real estate projects everywhere. But as you start to accumulate tokens, which can be, relatively easy to do, which is part of the point of tokenization, you can also take on a portfolio where you now have, your assets invested in jurisdictions all over the world, and each of those can have their own considerations. So you can end up with a bit of I guess what I would call almost like jurisdictional or adjudication risk of being sort of overly diversified around the world in real world assets, each of which have their own sort of recovery process. So we've talked to investors about a number of these things, but I think from purely an investor perspective, that those are some things that I would be thinking about.
All right, thanks for sharing that, guys. I do agree that investors should definitely take into account all the assets that they're investing into, especially with all the nuances and regulations. Now that we've kind of covered what it would look like for the investor front, why don't we talk about what it would look like for platforms upcoming in the RWA space? And with that being said, the next question is, what are the key criteria for obtaining licenses in the real world asset space?
Gene, I was just going to comment on something that Jason just said earlier about, the idea of who you're going to go after if it's truly fully decentralized, right? And so in Singapore, there's a project called Project Guardian, which is actually mandated and supported by the Monetary Authority of Singapore. And within it, they have a pillar. There's, I believe, 4 different pillars. And one pillar focuses on institutional DeFi. And what does that really mean? I guess it's basically where, what we've been talking about here all along, providing that level of security to your investors and comfort to your investors by doing some of the things that we're all accustomed to doing, right? KYC, knowing your customer, and AML, anti-money laundering checks, to ensure that you should be able to access the platform. But once you access that platform, the back end is all supported by DeFi applications. And this is basically what IkeSwap is, right? It's a licensed platform. And talk about recourse. Jason talked about who are you going to go after? Well, it is the platform that is facilitating this so that investors can reach out to the platform for support. However, the transactions that take place are taking on chain. There's removing the unnecessary intermediaries, right? And the settlement can happen on chain. So when you have all these stable coins that are on chain, on the flip side of that, you need all the assets to be on chain as well in order to facilitate that. And this is why we're doing what we're doing, is trying to bring more assets on chain. So there is that concept of having, a combination of both decentralization with some protections at the front end.
Yeah, those are pretty interesting points, Alice, that you put forward. And I guess it falls in line with what the next question is. So with these kind of the licenses that these platforms are going to undertake or try to acquire, what would be the key criteria that these platforms or upcoming protocols should be taking a look at when trying to obtain their own licenses in the RWA space?
Is that for me or?
Yeah.
I feel like I've been speaking too much. Feel free, Derrick, or anyone else to.
Yeah, probably we'll pass to Derrick. Yeah.
So maybe I can share a bit about the experiences we've had applying for our licenses. I mean, I think it's standardized across the board in different jurisdictions as well. What we usually required to do is, we are required to fill up and submit a bunch of forms, our business plans, our presentation decks. The regulators would usually want to do KYC AML on our UBOs, ultimate beneficial owners, and our officers as well, to make sure they're fit and proper, and to check to make sure that they pass all the disciplinary history checks. They would usually want to review our operational capabilities, our technology, and ensure that our policies and procedures are all in place. And finally, another major item is, making sure that we pay the licensing application fees and maintaining the necessary regulatory and operational capital. So all in all, it's a really lengthy process that requires lots of time, effort. It's capital intensive, and requires the applicant to really maintain a lot of resources, which is why we try to advocate for work together and partner with other players in the space who are lacking the licenses. We try to give them or offer them solutions to basically come to us, leverage our licenses so that they don't need to go out and go through all that hassle and of obtaining and filling out all the applications for their own licenses, because we know how painful it has been, and we've done the hard work, and we are fully fitted out and ready to go. So that's the easy go-to-market fix for them.
Any thoughts on the matter, Benedikt?
Yeah, I think the difficult thing to navigate, and I think this is something where so many misunderstandings are around, is what license do you need, to actually be able to validly operate in your home jurisdiction, and then obviously, what does that entail for all the places that you want to, offer your services to, and so I think very early on as a provider in this space, one has to really clearly think about, do I want to just, provide tech? Which markets do I want to provide this in? Do I want to provide a regulated financial service, one that is already covered, let's say, by existing regulation? Will it be something that will be subject to more novel legislation? And this then again, depends first of all on the qualification of the asset one offers, but then also heavily on the jurisdiction one offers them in. And I mean, here, there's just no strong level of standardization across the globe. And for example, as Obligate, we have always focused just on traditional financial instruments. So in many jurisdictions, actually, there's no bespoke digital asset regulation applying to this, but it's just the old traditional, MiFID or financial instrument legislation that is applicable. But this will really change from jurisdiction to jurisdiction. So I think when you make the commitment and you say you want to go into the RWA space and want to offer regulated financial assets, one just needs to be aware and conscious of what that actually entails if you also want to offer it beyond just your home jurisdiction.
Yeah, and if I can add to that, it is critically important for us to work out how to work with other licensed players in this space, right? And also other platforms in other jurisdictions. You couldn't possibly get licensed in every jurisdiction, right? So I think it's one of the reasons why we're working with the likes of Obligate and Methodic and Oasis and trying to figure out how we can introduce products across multiple platforms in a legally and compliant way, and offer the sought after interoperability. We're still very early in this journey, but I think it's a good start. One, we hadn't, all of us here have been shied away from regulation. In fact, I think a lot of people do want to play regulatory arbitrage, but we've actually taken the regulation component head on, being one of the first licensed players to go into the MAS sandbox, the Monetary Authority's sandbox, which is actually reserved for companies that utilize innovative technologies and products which are novel. And so there are progressive regulators, MAS being one of them, who want to support these types of initiatives, including the project that we did, EVCC, that was also supported by the MAS with an MAS grant. So I think it is critically important for all of us in the real world asset tokenization space to be looking at this problem of interoperability and how we can have wider distribution and collaborate with one another. And this is one of the first steps.
All right, JV, on to you. JV, you there? I guess, Jason, yeah, you can add in your thoughts here.
Sure. I think not to kind of shamelessly plug some of the projects that are on this call, but the ability, I mean, most managers, like myself included, are trying to solve distribution issues when they're thinking about licensing and offering RWAs. And I think that the complexity of dealing with licenses outside of a local jurisdiction is far higher than I think a lot of projects, especially smaller projects, give it credit for. So the type of work that Alice and Derrick do, I think, is pretty key to being able to access licenses. It is enormously expensive. It's very complicated to get licenses on your own. It's also very difficult to even just build business continuity and business operations that fulfill the licensing requirements of numerous jurisdictions around the world. It's a big thing to bite off. even things like asset custody rules and security and things of that nature can differ from jurisdiction to jurisdiction. So one of the reasons I love this industry so much is that it is very collaborative still, and it's very easy to find partners around the world, and that is absolutely the route that we have taken at Methodic to access various jurisdictions, is to find strong partners that are on the ground and are pushing into the licensing requirements, are active in the sandboxes around the world. It's it is a little bit unfortunate that smaller projects can't quickly and easily get licensing themselves, but at this point in time, getting leverage through a partner, we think is pretty critical for the purposes of licensing.
Yeah, and Jason, for smaller projects, nor do they need to get licensed themselves, right? If they're just looking at one project, there are existing platforms out there they can work with. Ours included, Obligate and Oasis Pro. Lots of different platforms out there that are already providing the infrastructure and the licenses in their respective jurisdictions. So hopefully we can help you save a few years and a few $100,000 or maybe more on your legal costs and structuring and token launches. That's our intention, at least.
Yeah, absolutely. It's you think about tokenization and fractionalization is increasing liquidity and increasing access. You also need in order to actually harness that, you need a strong licensing partner or platform that you can work with. So it's sort of almost part and parcel to being able to be successful in this space.
All right. I think we lost JV there for a bit. Is there anything you wanted to add to the topic before we move to the next question?
Can you guys hear me? Hello.
Yeah, we can hear you.
Okay. Yeah. Sorry about that. Yeah. I'd like to echo everyone's sentiments that it's different from jurisdiction to jurisdiction. But I think when we were trying to get our licenses, from a regulatory comfort angle, having a good mix of a team of experienced professionals from the traditional financial institution side, as well as professionals from the decentralized finance side, would really go a long way, versus if we had a team who were heavily skewed towards one side or the other. Granted, so I guess that's it.
All right, thanks for those insights, guys. I guess we can move on to the next topic here, and it's as we discuss more about the different types of investors and different types of financial institutions. The next question here is how can traditional financial institutions effectively incorporate real-world asset tokenization into their product offerings? And perhaps maybe you guys could give an example of what a tokenized product offering would look like, or what you guys are currently working on your respective platforms.
I'll let someone else go first this time.
All right. Why don't we let Benedikt go?
I think we've seen a lot of demand coming from the, for example, the commodity and trade finance space. And as platforms, providers working in this space, I think many of us face similar challenges. I definitely think what everybody else sees is just challenges on the distribution side. But many platforms also face the problem of adverse selection in the beginning. And this is something I think we're proud to say that we've been able to do away with that. We have prime issuances, we have investment grade issuances, and strong traditional players who would not have used this type of platform and infrastructure just 2 years ago, and today they're using this. And I think here why this is so exciting. It really just shows that the great maturization that on the issuer side, these types of platforms and technologies are much more accepted today than they were a few years ago. Public blockchain technology is much more accepted today because we can provide kind of that institutional grade experience, the regulatory comfort, and in the end they can use this as an alternative to actual bank-based financing. And so banks are also partially contributing even more to that surging demand because they are pulling out of entire segments of finance, and trade finance being one of them, exacerbated by, let's say, some regulatory changes, the Basel regulations on the risk weighing of assets in certain segments, and that leaves a big vacuum in the space. And I think this is where you can get prime issuers, really strong credit risk, but that have pain points you can address, and they have the openness to adopt new technology. And this is, of course, also, there's several angles to this, and there's also kind of a more ascending or emerging market angle to this, where I think, our technology can just offer tremendous value. Whereas, for example, in our home jurisdiction of Switzerland, a lot of even smaller companies, SMEs, they have very strong banking relationships. They get financing to extremely low interest rates, and the pain points are just not vast or big enough there. And this is why we really take a global approach there, which allows us to originate prime issuances from really great traditional investor issuers, and we can now make them accessible in a digital asset environment, which I think it's a great testament to how far we've come.
All right. Yeah, I guess, Jason, is there anything you want to mention here, bring up that you guys are currently working on that would kind of align with the question that's just been stated?
I think financial, you have to start with sort of a framework of, can a financial institution use the product to begin with, and the types of things that we're talking about here now are the foundation for being able to do that. What are the compliance issues? What's the regulatory framework? And once you have built a foundation of compliance, you can start to think about use cases, and that's what sort of interesting. What Benedikt was just talking about. You can think about use cases that financial institutions can leverage for tokenized real world assets, and we're seeing that starting to pop up all over the place. There has to be benefits to it. There has to be economies of scale. It has to solve some sort of a problem, which we're seeing certainly in the lending space. Tokenized repo markets are starting to explode in volume that they're doing, because there's a real inefficiency that's being solved by tokenization. I think this business cycle, or this crypto cycle, if you will, with RWA is really starting to move past what I think a few years ago was kind of the novelty phase, with the exception of probably stable coins, which were always extremely impactful and useful. And we've kind of moved past the novelty of being able to do it, and really able to drill into the use cases for tokenized RWA with financial institutions, and even have seen companies in our space helping to build infrastructure inside traditional financial institutions that allow them to actually transact on tokenized assets, because you can have all the use cases in the world. If you don't have the infrastructure to actually do it, you can't execute against it. And we're seeing that being solved all over this space. there is a lot of hype for, RWAs and tokenized RWAs and financial institutions. I think we've got it right this time. So I think it's pretty exciting to see how people are bringing use cases to financial institutions and starting to incubate them on just a solid compliance and regulatory foundation.
Yeah, I want to touch a point on that use case before I pass the question to JV, Derrick, and Alice here. Maybe you could explain more about what that use case would look like on Methodic's side, on Methodic's side, more especially the Methodic staking fund.
So, looking at it through that lens in particular, we've talked with a number of institutions that are in this sort of nascent stage of moving on chain, and starting to think about ways that they can either move business segments on chain or build new business segments that are on chain. And in order to do that effectively, you have to be able to transact on a chain, which actually requires the native token of the chain in question. So if you're talking about the Ethereum chain, you're talking about ETH, and in this in-between period where you may not have the infrastructure completely built out, you may not have the use cases fully formed, but you may have a forward-looking view where you're saying, I recognize that in 12 or 18 or 24 months, I'm going to be deploying on-chain, and therefore I want to be accumulating crypto now. One thing that we are helping companies to solve is almost operating as a bit of a treasury solution by using a private fund structure that has been tokenized and is distributed through a platform like InvestaX, but is also capable of being distributed purely off-chain and operating as that bridge. So being able to access ETH, being able to access staking rewards for accumulation purposes, and being able to do that today, using private fund structures, which are very familiar, very known, very balance sheet friendly, so that later on you can access that crypto that you've accumulated once you start actually needing it for utility purposes. I mean, one thing we forget in these cycles of crypto is that there is a utility. It's not just a speculative instrument, crypto in particular. And so we really think about the utility and being able to help institutions accumulate the crypto that they need to actually put a lot of what we're describing to work.
All right, thanks for that, Jason. Yeah, I think Alice, you wanted to mention something.
Well, I was just going to talk about, you asked about our products that we're working on, right? In line with what Jason said, is bring more products on chain, as well as Benedikt, bring more products on chain. I mentioned earlier, we tokenized the very first Singapore variable capital company. This was a purely on-chain tokenized fund structure with no paper registry. And what we are now doing across both platforms is creating a similar structure, an on-chain structure for funds. We call it OTPs, on-chain. Yeah, it sounds like the what is it, one-time password or something, but it's actually on-chain tokenized portfolios, right? And this is essentially portfolios that are natively reside on chain to invest across all types of crypto underlying. And that is actually receiving a lot of good interest. It's kind of mirroring what we started off with the EVCC project, which was a very institutional, high level with UBS, State Street, to this smaller type of segment allowing anyone, smaller fund managers, smaller investment managers to set up these structures on the IXSwap platform. I don't know, Derrick, did you have anything else you wanted to add about that?
Yeah, we've spent a lot of time, I think, doing a lot of research into looking at various different structures. And what I mean by this, in putting together the whole thing, looking at different corporate entities across different jurisdictions, sort of weaving in all the different parties, this OTP structure, figuring out how the funds will flow between the entities, the contracts that need to be put in place between the various parties. So all of this has been done in a very sophisticated manner, I think. And interestingly, as we all know, there are various countries across the world coming up with, interesting and intriguing new structures, some which are, coming up from countries which are more crypto friendly. And we basically looked at a few different options and some which actually interestingly allow for blockchain native entities to be set up, and these we're trying to take full advantage of the new friendly regulations that are being introduced, and incorporating that into this new fund structure that we have.
Yeah, this is why I love what I do, because we get to look at innovative structures, never a dull moment, always doing new things and new structures. ETFs wouldn't exist if people didn't innovate. And we kind of like to think of ourselves as trying to push boundaries, as we all are here, everyone on this panel. And I think a lot of us come from a traditional finance background and never look back, right? This is way more interesting. Anyway,
yeah.
Gene, are we out of time?
Yeah, we're getting there. I also wanted to just add in JV here. I think he mentioned something really interesting about working with the Philippine government to tokenize some interesting product. So maybe JV could probably give us a bit of background about that.
Yeah, sure. Is it all right if I answer the question first, or?
Yeah, definitely, yeah.
All right, great. So the way we're thinking about it in terms of how the traditional financial institutions can incorporate them, so we're looking that there's the extremely painful path where they'd have to undergo the various board and management committees, such as the risk committees, the operations side, the ALCO side, and even the investment committee component. But I think the more pleasant path is riding on the existing framework of the equivalent asset. So say for tokenized bonds, if the treatment is similar to the equivalent instrument, then from a risk-based perspective, not considering the operational risk component, then there should be no issue in terms of the investment parameters that traditional financial institutions already have. The barriers in both cases, however, would be the custody and trading component of these assets. The traditional financial institutions would need to set up the cryptocurrency custody infrastructure to support this, as well as set up the necessary processes and procedures to operationalize the trading of these assets. So if traders and investors primarily use Bloomberg right now for all of their trading activities, to be honest, it's kind of hard to imagine them using MetaMask to buy assets on chain. So I echo the sentiment here that there really needs to be institutional grade trading platforms that directly connect with institutional grade cryptocurrency custody infrastructure.
All right, thanks for that, JV. So we're kind of overrun on time here, so I'm just going to jump into a very interesting community question, which I think you all would love to answer. So before we wrap this up with one final question from the community, this question being, so with this year, Bitcoin ETFs were recently tokenized. So the question being, will we see more regulatory entities warm up to the idea of a more digital financial landscape following this? Yeah, so maybe perhaps anyone from you would love to answer that question first, and we'll take it from there.
I would say 100%. I large financial institutions entering into the space and making huge investments is going to leave an indelible mark on regulators. I mean, one thing to sort of remember is regulators don't wake up in the morning and say, what can I do today to fundamentally change the financial system? They wake up in the morning and say, what do I need to do today to protect investors? So there's always been a little bit of a speed mismatch, maybe a lot bit of a speed mismatch between crypto and DeFi and the regulators. And I think what we've seen is large institutions come in and make huge commitments to straddle the gap between the existing system and regulations and future system and regulations. So I think in succinctly 100%, I would say yes.
Any thoughts from any other speakers?
I mean, I do think again, what's really important is, on the one hand, yes, we want to get institutional finance on chain. We want to provide them with the level of comfort that they're used to, and at the same time, we also want to build products. Not necessarily how. If you would ask, a banker who trades via Bloomberg, and you ask them, how do you want this product to be built? At the same time, we need to be bold enough to build something that they might actually not know they need right now. And this is really, I think, the balance that needs to be struck. Because what would be, I think, a real pain is if we look, 5 years down the road, and we see, what has become out of the kind of the RWA space or the tokenization space, and we see just mostly tier one financial institutions, doing finance in a fairly inaccessible way and with the same level of intermediation as it is done today. And I think that would be a pity, because then we didn't really unlock the true potential of the technology. So, and I don't think the big, financial institutions, although they all are involved with tokenization projects, but they've been involved in that. They've been doing POCs for more than 6-7 years with tokenization, and few of these things have actually been put into into full operational mode, into full commercialization mode. And that's why I really think it's up to the the startups to work together with them to really push them. And I think there's a few examples of startup players, like, for example, Figure out of the US, which have really transformed existing financial markets. In this case, the home equity line of credit market. And I really want to see more of these. And I don't think it's, we cannot leave it up to the banks to take the financial market infrastructure to the next stage of evolution. We need to do that together with them. Yeah.
Yeah, just to echo some of the sentiments that have, I think, been mentioned here. I think, yeah, definitely, the ETFs being approved, it's going to, it sort of has, signified that, there's a stamp of approval being given, which is, I think, very important for mass adoption, right, for your average moms and pops out there. Financial literacy is, I think, in many different countries, it's still lagging behind, more so with the advent of blockchain or crypto technology, right? There's always the fear of the unknown. People like to go with their confirmation biases, and I write a lot about this on LinkedIn, actually. I think with these new set of approvals and what's going to come, I think it will slowly warm people up to the idea that it will sort of reverse the mistaken and repeatedly wrong conception, I suppose, that all of crypto and everything that has to do with blockchain technology is all a scam. Yeah, I'm hoping and I'm very bullish in the RWA and in the entire Web3 space as a whole.
Any final thoughts on that, JV and Alice?
I think I missed the question, but is this the final departing thoughts?
Yeah. This is the last question from the community. With the question being, with the Bitcoin ETFs being passed, will we see more regulatory entities warming up to the idea of a digital financial landscape?
Yeah, I think I touched upon this point earlier. With the ETF approval, you're definitely seeing more institutional engagement, and there was previously just no way to really for these institutions to access, even though we said institutions are coming, but they really needed the right infrastructure, and the ETFs I think gave them that, and also the comfort as we spoke about, but we're just talking about Bitcoin and Ethereum ETFs, right? There's a whole world of assets. And like Derrick, we are very bullish on the tokenization of all assets, real world assets. Everything should just live on chain. It's taken a lot longer than we've anticipated or hoped, but we're definitely seeing the buildup and the interest build even more recently than ever before. And I think it's because it's kind of like when I look at why did AI just become such a big thing, even though it's been around for 20 years or longer, right? And it's because you could actually put it in the user's hand. With ChatGPT, you're able to, as a user, use it on a daily basis for whatever reason. Put your PowerPoint presentations, get a response, draft your emails, even kids doing their homework, right? But what it did allow users to do is to be able to use it in their own personal capacities. And what I think RWA allows people to do is also use it in their own personal capacities, whether it's an asset that they own, whether it's an asset that they're familiar with. It's no longer this, intangible off the, it's somewhere in the ether type of phenomenon, but it's something that they can actually use this technology to represent and hopefully bring this more into mainstream adoption.
All right, thanks for that, Alice. And last final thoughts from you, JV, before we officially end this panel spaces.
I think everyone here raised really great points. I just like to add that as long as the structural benefits are clear to the institutions, so the elimination of counterparty risk and the resulting deeper liquidity, then the interest will definitely grow. So I think it's just a matter of time. That's it.
All right, I think that sums it up for our RWA legal panel spaces for tonight. I'd like to thank our guests for coming in on here, especially Jason, who's coming in from an early morning call. I guess that's it for tonight. I'd like to thank everyone for joining in as well, and I hope you guys gathered a lot of insights as much as I did. So with that being said, I hope you guys have a great day or a great evening. Thanks, guys.
Thank you.
Thanks, everyone. Bye.
Thanks, everyone.